Welcome back. With the Bank of Canada, the Swiss National Bank, Sweden's Riksbank, and the European Central Bank all having cut interest rates at least once. The global easing cycle is now upon us, and the Bank of England looks set to cut next. But some large-scale entertainment events might make that a bit more difficult. They're calling it Swiftflation, with worries that Taylor Swift concerts in the UK this summer will temporarily bloat key inflation metrics and make the Bank of England's job that much more difficult. Let's bring in James Rossiter. He's head of global macro strategy at TD Securities. James, thanks a lot for joining us. We'll talk as best we can about all the banks and the easing cycle. But what are you seeing in terms of Taylor Swift, her concerts in the UK, and the economic activity that they generate?
Yeah, well, look, I mean, we gather our hotel price data all the time in our effort to kind of model inflation as best we can. And we were doing it a couple of weeks ago, just as she landed in Edinburgh, and noticed that, well, hey, isn't that funny? Prices are starting to rise a little bit higher than they normally would at this time in Edinburgh. A few days later, of course, she's playing Liverpool, and hey, funny enough, same thing. So we saw the pattern there, and we figured, well, hey, let's write something, get something out, because this could be an important feature of the UK inflation data. The London dates just came and went. It looks like maybe for June it's not going to get picked up in inflation the way they sample the data, but she's back in August, so we could be looking at the same thing, just a couple months from now.
And you think this could be actually material to upcoming inflation prints that these central banks would look at closely, the Bank of England chief among them?
Yeah, I mean, look, it's material to the inflation print itself. I think we've got to expect central banks to understand as best they can what's going on in the data, of course. They'll probably recognize that there's some sort of, temporary entertainment boost here. Their job is probably to look through that. They're more focused on inflation a year and a half, 2 years down the road than they are in August 2024, for example. But it's just going to make that job so much harder than it would be otherwise. And we'd already been detecting some increased pressure in some of these service prices earlier on in the year. So, whether that was kind of just because there's generally firmer demand from higher real incomes, or whether there's just kind of one-off things going on, it's just going to make their job that much harder. And look, every central bank is, while they're heading towards those cuts, they're doing so with a lot of hesitation. They're not that confident in doing it. So a muddy picture is just going to make it all that much harder to do it with any conviction.
What do you think the rate picture is going to look like a year from now in Europe, in England, and right here in Canada?
Well, we're generally looking for fairly sustained set of rate cuts once they start going. So for the Fed, we see rate cuts starting in September, sort of at a quarterly pace. For the ECB, they've already started. It's another quarterly pace from here on, basically all the way down to neutral, sort of into early 2026. The UK, we expect to start in August, and then sneak a couple of extra cuts in around the end of the year. So we'll probably get 3 cuts in this year for them. And then for the Bank of Canada, we're looking for a series of cuts just to sort of continue throughout the year, ending the year around 4% for the overnight rate there.
In some notes, you say the Bank of Canada perhaps has the clearest path downward. That's interesting because I've heard a lot of people say they expect the bank to perhaps cut, pause, something like that. You seem to see a more consistent pattern of cuts, correct?
Yeah, I mean, look, we've got some pauses in there for sure. It's not every single meeting that they're going, but when we look at the inflation data in Canada compared with other places and the momentum, we like to look at this 3-month on 3-month rate of inflation to kind of capture the shorter term dynamics, but it's not too noisy either. So you get a cleaner signal that way. And Canada's really doing quite well by those metrics, compared with Europe and certainly compared with the US, where it's very stubborn and they're struggling a lot more to kind of get the all clear to start cutting rates there.
What does all this mean to the currency market? It sounds like it means a stronger US dollar in the midterm as all these central banks cut while the Fed waits a little longer.
Exactly. Yeah, no, the Fed is definitely going to hesitate. And even once they start going, we think it's going to be a very cautious tone. That should give the dollar a bit of a boost towards the year end. We also see, there's always seems to be a bit of a geopolitical premium in the dollar around US elections, regardless of the candidates. that should help benefit a little bit. So, by the end of this year, we're looking for euro against the dollar at 102. We're looking for dollar CAD at 141, sterling against the US dollar at 119. So it's a few percentage weaker in most currencies against the US dollar from here for the next 6 months.
Can you express your Canadian dollar target in US cents?
Yeah, it's about 69 cents.